You've done what you do, which is to say survey the macro landscape. This time, you found some troubling signs. What specifically is of concern?
Well, I think what we're seeing, I'm not sure it's troubling, but there's clearly a disconnect where we've got $10 trillion of negative yielding rates around the world. And at the same time, you've got major deficit increases in most of the developed markets and bigger debt loads in corporations. So that seems somewhat anomalous to have low rates when leverage is going up. And so I think what we're seeing from a lot of investors right now, certainly insurance companies and pensions, is there's a real investment risk today, which is most people didn't expect rates to be as low as they are, and they're trying to find ways to generate income. And that's really been a focus of KKR past couple of years, but we've really stepped on the throttle in terms of, or stepped on the pedal in terms of accelerating our push into some of these income-generating markets.
And by the same token, the forces of demographics on the one hand and technological advancement on the other are keeping a lid on inflation.
Yeah, I mean, we put a piece out today that I think highlights, really on the technology side, a point that I think a lot of investors are missing, which is technology, if you use the U.S. as a proxy, is leading to about a 40 basis point decline in annual inflation. That's
every year.
Every year. That's a major. I mean, think about the announcements we had 2 weeks ago with Walgreens, with generics. They had issues around pricing. We had the same thing where Amazon bought Whole Foods, and 2 weeks ago they announced that they were taking price cuts of 20 to 50%. There's really, I would say, a headwind to inflation coming up. And if you couple that with demographics and then just slower GDP growth in China, I was in China last week, and I've been going there for a long time. I mean, nominal GDP growth in China used to be 20%, and now it's somewhere between 6 and 12. And so it just feels slower. And in that environment, it's very hard for interest rates to break to the upside.
Henry, you call this the uncomfortable truth.
Yeah.
Is that, and this is not as facetious a question as it may sound, is that closer from an investor's standpoint, right? Is that closer to Al Gore's inconvenient truth, right, or Jack Nicholson's you can't handle the truth?
I think it's a little more that you can't handle the truth, which is, to me, your later cycle, this is a time where you want to own yielding assets, but you want to have ones that don't have massive duration risk. And so as a firm, what we've been trying to do for our clients is really find collateral that's linked to nominal GDP. So things around housing, things around aircrafts, locomotives, infrastructure. Infrastructure is a huge business for KKR. Real estate credit, where you have some collateral that if we go into a downturn, you have something to hold on to. But it's also cash flowing, and we've tried to do it using leverage that's not outsized.
And that's because in the interim, inflation is effectively non-existent, and you think rates are going to be lower for longer?
I do. I think if there's a risk, it would be the late 1960s analogy, where ultimately you had very low rates, and then you had some policy mistakes which hurt you in the 70s. I think today what's different is the demographic picture is much different. Savers really are dominating the market, and we don't see the policy mistakes in terms of the central bank. I think clearly the U.S. is leading the charge on running bigger deficits. It's one of the reasons we want to have some inflation protection. But again, we're trying to do that barbell of having inflation protection, but also having some outsized yield for investors.
Give people a sense of what to expect. Where do you think we'll see the bottom on Fed funds? Where do you think we'll see the bottom on the 10-year Treasury?
Look, I mean, to me right now, the market is offsides, which is the equity market. It right now has three quarters of no earnings growth, and it has 10% growth in the fourth quarter, saying things are going to be fine. The bond market saying there's a 70% chance of a rate cut by September. Can't be both of those. So to me, I think there's a better chance that the Fed does not cut. That would be my analysis for this year. But I also think that hockey stick earnings growth in the fourth quarter is probably a little miscalculated.
What about Europe? Benchmark rates already negative.
Yeah.
Is that working?
Look, I think what Draghi did with their latest LTRO program, which is a program they lend to the banks, that will mean that rates stay lower in Europe for at least through 2021. And I think for global investors, you have to remember U.S. rates for the past three decades have never traded 250 basis points or more above the Bund. And the Bund is at 0 to 20 basis points. points. So we're not in the camp that rates are going to have a massive backup. They may trend up somewhat, but I don't think you're going to have a cataclysmic, bond market sell-off the way you did in 1994.
Henry, you've been parsing the words of central bankers for a long time. Since you brought up Draghi, I have to ask you this question. What do you make of his implicit warning that the Fed's independence may be in question?
Well, I think generally most central bankers want to be left to do their job, and their mandate is not to please the politicians. Their mandate revolves around inflation, and it revolves around growth. And I think he's just sending a shot across the bow that, given some of the comments coming out of the U.S. administration, to let the Fed do their job. And I think that, one, it's a statement of confidence in what the Fed can do, but two is I think he's pushing some of the authorities to take a step back and let them do their job.
Do you think the prospective nominations of Stephen Moore or Herman Cain do put the Fed's independence in question, if not at risk?
I think the Fed has a great committee that they have right now. I serve on one of the advisory committees for the Fed. I think they're incredibly intelligent group. I think anybody who ultimately gets approved, and that's why you have a process, will be reflective of the values in the central bank. I mean, look, I was just down in Mexico City. There's clearly a new administration with AMLO down there. I think the central bank has been able to maintain their independence. I think the same thing in the U.S. To date. But look, I think what Draghi is saying is buyer beware, and I think this is something we'll have to watch closely. But I'm not sitting at my desk at work thinking that the independence is being undermined currently.
What would you need to see, Henry, to advise investors to start raising cash, shorting stocks, and allocating more aggressively to distressed debt strategies?
Well, look, I think that I think we're moving into the next 5 years. I think will be a lot better for distressed. I mean, that's actually been one of the worst asset classes to be into, given what's happened with quantitative easing. I think as money starts to leave the system, albeit more slowly than what we thought a year ago, that's going to create that situation where the water comes out of the swimming pool, and we'll get to see who doesn't have their bathing suit on. And ultimately, every cycle has this, which is corporations take too much credit, they get over-levered, they want to grow things to the sky, and it doesn't work out. Look, you've seen that in energy already. You've seen that in retail. It wouldn't surprise me that you see that in some sectors like software and healthcare and industrials over time, but it's going to take a little time for that to unfold.
You mentioned earlier that you'd been to China recently. You came back with some thoughts on the prospects for U.S.-China trade. What are they?
I think the near term is actually more positive than what folks think. I think you have to be more nuanced. I think when you and I have talked before, we've tried to peel it back a level. And here's what I would say, which is I think the U.S. will keep the $50 billion that they originally put in place. I think there's a chance they roll back the $200 billion. I think President Trump needs some growth going into 2020. I also think it sends a nice sign. But in my 20-plus years of going to China, it goes back to something we talked about, I think, maybe 2 shows ago, which is I think there's a divide. And I think that the China-U.S. relations related to things like technology, that's more structural. And I think it will affect supply chains. I think the way people think about expanding globally, Asia becomes more regionalized, the Americas becomes more regionalized, and Europe will be somewhere in the middle. And let me make one point. That's not insignificant for Europe. Europe gets 49% of its gross GDP from exports. So you saw them as China slowed, they really slowed down too. And so a lot of our focus right now in Europe is really around finding industries that can go beyond that global slowdown that's being forced upon them, and that's led us to technology and some areas in consumer experiences.
What about the impact of, well, let me say this. If I understand you correctly, from what I've read in your latest report, which, by the way, I urge everyone to read because we could barely summarize it here, the Chinese economy, the slowdown has bottomed.
I think it's been arrested. I think there's a clear message from being on the ground in China that the stimulus that they did, both monetary as well as some of the supply side, is starting to work.
So when does the impact of that stimulus felt in places like Europe, either in the consumer industries or the manufacturing
Probably
industries?
the third quarter. I think
that much of a lag.
I think there's a little bit of a lag. And by the way, I think unlike in the past where it was just pure monetary stimulus, where you had more of an immediate spike, I think this will be much more gradual. I think that's an important consideration, which is nominal GDP in China has gone, when you have a fixed investment economy, you can grow 15 to 20% nominally. Today, as a service economy with a demographics in their face, I think you grow maybe 8 to 12% nominally, and that's real GDP just north of 6%.